Ladies and gentlemen, good day and welcome to the 4Q FY22 earnings conference call of Metropolis Healthcare Limited, hosted by InCred Equities. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. The statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Agarwal from InCred Equities. Thank you, and over to you, sir.
Yeah, hi, good morning, and InCred Equities welcomes everybody to this call today to discuss the fourth quarter and full year fiscal 22 results of Metropolis Healthcare Limited. We thank the company and the investor relations team for this opportunity to InCred to host the call. We have the senior management team of Metropolis for this discussion, represented by Ms. Ameera Shah, the Managing Director, Mr. Vijender Singh, the CEO, and Mr. Rakesh Agarwal, the CFO of the company, along with the SGA investor relations team. I hand over the call to Ameera now for initial performance highlights, and then we'll get into the Q&A session. Over to you, Ameera.
Hi, good morning, everyone, and thank you for joining us on the Q4 and FY22 earnings call. I hope you and everyone around you is safe and healthy. I'm joined today by Vijender, CEO, Rakesh, CFO, and SGA IR advisors. The presentation and press release have been issued to the exchanges and uploaded on our site. I hope everyone has had the opportunity to go through the same. I'm very pleased to say our company recorded its highest ever revenue, EBITDA, and PAT during FY22. Revenue increased by 23% year-on-year to 1,228 crores. EBITDA before CSR and ESOP increased by 20% year-on-year to 362 crores, and PAT increased by 17% year-on-year to 215 crores. FY22 has truly been a transformational year for the industry. While there has been a lot of action and consolidation, we have witnessed landmark M&A deals that clearly indicate the leader's confidence in the long-term prospects. This is further strongly evidenced by the fact that new players have emerged in this space, whether it is hospital players, large conglomerates, e-pharmacy players, PE players, etc. This is very similar to the phase we witnessed between 2012 to 2016, where a whole lot of new players entered the market, but very few could survive the marathon. We believe the increased online competition will expand the wellness market by educating customers, and good quality customers who value service and quality will naturally seek best-in-class brands like ourselves. New brick-and-mortar competition may create competitive pressures for price-sensitive B2B business for the top 100 tests, and our strategy of focusing on specialized tests above these 100, which most existing and new players do not do, will help us. These factors will lead to a faster shift from unorganized to organized, whose share today is a mere 15% of the market in our estimate. In the middle of so much action, we have continued to work on our expansion strategy, which we strongly believe will continue to give us well-rounded growth. Vijender will speak a little bit more on this in the remarks later. In the past few months, with the entry of newer players, there has been a lot of discussion around disruption, test prices, its impact on test volumes and revenue growth. The question in everybody's mind has been what therefore happens to incumbents, and will business erode the way it happened in some other industries temporarily? And as we are flooded with these questions and more, I would like to take this platform to explain the industry situation and our strategy at Metropolis. Let's step back and understand why the healthcare industry is not like any other industry. In healthcare, it is important to understand that trust, science, and consistency of reports and tests play a very critical role. In diagnostics, the doctor's medication to a patient is based on the basis of a scientific correct lab report. Also, we have to remember that in the illness space, tests are not commoditized. A liver function profile at one lab is not the same as another, so a simple price comparison is difficult when the ingredients are not the same. Doctors understand these nuances, although patients don't. And this is where we believe pricing disruption will be low in the illness space, because doctors, who are the biggest influencers in diagnostics value chain, are more concerned about the quality of the lab and the consistency of the report rather than only pricing, especially in situations of moderate to critical illness. And therefore, it is important for me to discuss the evolution of Metropolis in the last 40 years to help you understand our true value proposition. Metropolis is a science-based diagnostic lab chain in the illness space and a pioneer of specialized tests. We started as a specialized test lab and have slowly and steadily earned the trust of doctors over the last 40 years. We are the largest pathology lab chain in the country today with regards to our test menu, and that is a big differentiator in the minds of the doctor and the patient, so that when they get pricked by a needle, they're able to get all the tests that they need at one shot. This, in our opinion, is challenging to replicate, and any other player who wishes to scale up will have to go through the same process as ours. Discounts can give you a bump in revenue on the short-term basis, but the real question is, are you really creating a consistent, quality-focused, scientific approach to diagnostics for the doctors to recommend your brand to patients? Having said this, we also believe that there is a segment of business that will be influenced by low prices. And this is the segment which has a low influence by doctors, which is not illness but wellness-based. The competitive intensity in the budget wellness space, which is the low price, low revenue per patient wellness space, will increase and create margin pressures for people who are in that space. And therefore, we at Metropolis have stayed away from the budget wellness segment of the industry and have rather focused on the premium wellness segment, where scientific image and the right education to the customer matter. Our wellness revenue per patient is 3 times the budget wellness space and continues to grow at 50% in FY21-22 despite the competitive intensity. Let me now talk about how we have insulated ourselves from disruption. There are 3 types of customers who opt for a test: acute, chronic, and preventive. Acute patients are the ones who are suffering from a disease and require immediate treatment. Chronic patients are the ones who require testing at regular intervals to monitor their condition, while preventive customers are the ones who opt for wellness tests when they are well, and this is clearly not illness-based. As per a report by Bain & Company, acute patients, like ones suffering from heart, lung, kidney disease, or cancer, or something critical, are the most influenced by doctors and less concerned about prices, as improvement in their health is their immediate priority. In fact, it is impossible for patients who are non-medical to understand the differences in tests, lab quality, raw material ingredients, and therefore the decision maker. And chief influencer is the doctor and not the patient. Chronic patients who suffer from diabetes or blood sugar or thyroid disorders or the like are moderately influenced by doctors and likely influenced by prices. They need consistent reporting from one lab, as they need to monitor levels of test results to the last result for them to know if they are okay. Changing labs just for prices and discounts will be harmful to the health, as labs give different results and different normal ranges based on different equipment. While wellness consumers are least influenced by doctors, less aware consumers are highly influenced by prices, and the more aware consumers care for quality and service. Hence, as the new players in the industry do not have doctors' trust, they can impact the preventive segment, followed by the chronic segment to some extent, but extremely challenging in the acute segment. We at Metropolis are a specialized acute-focused lab with majority of our volumes coming from acute patients. Our main customers is a specialty doctor who trusts us and refers their patient to us. We have a smaller segment of chronic patients, and as chronic patients are moderately influenced by doctors and prices, we plan to mitigate this impact by loyalty benefit programs for the chronic patients. Loyalty benefits will help us to make our chronic patients' business stickier in nature, and they will find no value in switching to another player. In a nutshell, while it may look that the whole diagnostics is getting disrupted, like telecom, retail, FMCG, e-commerce industry did, if you dig deeper, you will find that in fact only a small part of the business is actually getting impacted, and we are generally well placed to compete. Apart from these initiatives during 22, we have stepped up our digital play with full stack investments across the digital sphere to make Metropolis technology ready. We are investing in tech to ensure the entire ecosystem which engages with Metropolis is optimized. Let me highlight a few of these initiatives. During Q4 FY22, we have been able to roll out our new app with a revamped user-friendly UI. This app is being constantly monitored for reviews, and feedback and actions will be taken on priority. Customer can view his or her lifetime reports, smart reports, easy booking, can track sample location and status through the new app. We have planned targeted marketing activities, especially in the focus on seeding cities through Google search, SEO, optimization, and content marketing. Customer lifecycle management, where we engage our customer database through updated test offerings and offers as per customer profile. And we have completely digitized our system for our partners and doctors, enabling WhatsApp Connect, as well as complete automation from end-to-end process. This is leading to customer self-serving and helping us to save employee bandwidth. We have spent close to 18 crores for technology initiatives to drive digital transformation. We expect this to partly continue in FY23 as well. All these investments on digital marketing and expansion of service network will have some minor impact on the margins. But once the systems are set, these investments we make now will create a backbone for the next level of growth that we envisage in the business. It will help us to safeguard our margins, keeping in view the increased intensity of competition going ahead. FY22 has been an exceptional year with COVID income contributing 16% of the top line. The non-COVID business grew at a robust 35% year-on-year for FY22. It grew 7% YOY in Q4 FY22 in spite of a COVID wave in Jan and February, while on a Q-on-Q basis, quarter-on-a-quarter basis, it grew by 10% in Q4 FY22. In spite of multiple disruptions, we were able to upsell and cross-sell, maintaining a high level of superior product mix and growing our revenue per patient and test in Q4 FY22 and the whole year as well, a strong testimony of the strength of the Metropolis brand. In Q4 FY22, we have also started work on ESG as per our commitment. We will give more disclosures as we complete certain milestones. In FY23, we believe growth may optically look subdued in the Q1 of FY23 on account of a very high base in Q1 FY22 on the back of COVID wave. Business will normalize from Q2 FY23 onwards unless no new waves of COVID hit us. We also expect the specialized tests and our premium wellness to grow in the normal environment, which will benefit us in the continuous improvement in product mix, leading to an increase in revenue per patient. Having said this, we believe an aggressive network expansion, employee cost pressures, and digital investments will also have a little bit of impact. And therefore, for 23, we believe we would target pre-COVID margins. That's all from my side. Vijender will now take you through some of the operational parameters.
Thank you, Ameera, and good morning, everyone. Let me talk about the key performance highlights for FY22. On COVID and non-COVID business first, I'll talk. FY22 started with deadly second wave of COVID-19 with India recording its highest ever case of COVID-19 during the month of April and May 22. The cases reduced as we have progressed before spurting back in January 22 with the third wave of Omicron. Accordingly, the COVID RT-PCR revenue contributed 19% of the revenue in Q1 FY22 and dropped gradually to 12% of revenue in Q4 FY22. Along with the drop in test volume, continuous pricing capping of COVID tests downwards also led to lower revenue contribution for full year. COVID revenue dropped by 17% in FY22. FY22 was a year of ups and downs in the sense that COVID continued to be present at some or the other parts of the country throughout the year, and when COVID tends to persist, it takes a bit of toll on non-COVID business. This is because in general, people tend to postpone tests which they can afford to when it's not safe to move out. However, in spite of all these challenges, our non-COVID business grew by 7% year on year, contributing 80% to total revenue in FY22 as compared to 77% in FY21. On acquisition of high-tech diagnostics, we successfully acquired high-tech diagnostics during FY22 for an all-cash deal of rupees 636 crores. Happy to share that the non-COVID business for high-tech grew by 35% in FY22 to rupees 100 crores. That is 81% of the total revenue in FY22 as compared to 60% of the revenue in FY21. COVID revenue dropped by 56% in FY22 to rupees 23 crores in FY22. That is 19% of the revenue in FY22 as compared to 40% of the revenue in FY21. Such higher revenue contribution and growth from the non-COVID business is a sign that business has been scaled up on strong fundamentals and is not a one-time beneficiary of the COVID wave. Its strong B2C connect has also led to this strong growth. Our focus now has been on time-bound integration of high-tech with Metropolis to extract the maximum possible synergy from the deal. Going forward, we plan to launch 100 new centers in FY23. Our work on integration has commenced fully, and we are confident to see an uptick in the margins of high-tech business led by better raw material purchases, IT process integration, increase in contribution of wellness business, and using Metropolis sales and marketing infrastructure along with increasing B2C contribution of overall business. Now on expansion of lab and service network. We embarked FY22 with a network expansion plan with a view to deepen our presence across geographies and increase the B2C ratio of the business. We had planned to add 90 labs and 1800 service centers between FY22 to FY24. During FY22, we have added 16 labs and 509 service centers with unexpected COVID waves. We are confident we will reach out desired goal of 90 labs and 1800 centers as we have built a strong pipeline of new projects. Now I'll talk about on home visit coverage. During FY22, we widened our home testing service to 100 plus locations from 60 and from 60 locations in FY21. This has resulted into 23% revenue growth from home testing for non-COVID business. Overall, home testing business including COVID has remained at similar levels at rupees 135 crores. This is due to share drop in home testing from COVID tests, which is on expected lines. The economics from a home testing keeps on improving as a center matures and volume throughput for home testing increases. Let me now come to key performance metrics and operational numbers. Revenue share of B2C focus business in focus cities for non-COVID stood at 60% in FY22 versus 58% in FY21. Our near-term target is to reach 65% contribution. Revenue contribution from specialized tests for non-COVID stood at 40% in FY22 versus 42% in FY21. Revenue contribution from wellness tests increased to 9% in FY22 from 7% in FY21. We recorded strong 37% growth in number of patients to 13.4 million in FY22, while number of tests increased by 35% year-on-year to 25.7 million in FY22. The revenue per patient for non-COVID business increased by 2% year-on-year to rupees 947, and revenue per test for the non-COVID business increased by 7% year-on-year to rupees 447. Our revenue profile among focused, seeding and other cities stood as follows. Focus cities, 5 cities including the city and peripheral area around metropolitan regions, contributed 60% to the total revenue in FY22. Seeding cities, 8 cities including the city and peripheral area around the regions contributed 20% to the total revenue in FY22. The rest of the other cities contributed 20% of the revenue in FY22. With respect to geographic distribution, revenue contribution from West region was 56%, South contributed 25%, North contributed 8%, while the rest was contributed from East and international locations. I will now talk about the Metropolis strength at the ground level. Our analysis has shown that the productivity per center in our business has continued to move up higher. That is, the revenue clocked by a new center in its first 12 months is increasing in each passing year. We have witnessed this in most of our focus and seeding cities, which gives us confidence to keep expanding our network. In fact, the productivity of the centers opened in 2017 versus 2021 has also seen a marked increase, signifying better screening and selection of franchise, better acceptance of the brand Metropolis, moving up the value chain in terms of product mix and channel mix. This will also mean that we will achieve faster break-even levels in our newly expanded network than in the earlier periods. Take in case Mumbai city, the most significant focus city for us, which contributes highest revenue. The productivity of new center has increased even the most recent period in spite of increasing competitive intensity in the city. We believe there is still a significant headroom for us to grow, and hence we have decided to add 150 centers in FY23 to take the walk-in center network in Mumbai from 341 in FY22 to 491 centers. We intend to expand similarly across all our focus in feeding cities to capture growth opportunities. Our focus will be to continue growing revenue from existing centers, while new centers will become our growth engine. While revenue growth will continue through increasing volume, we also keep on putting efforts to increase the revenue per patient. This is done through upselling and adding value to the customers via tests that can be offered exclusively by Metropolis. To conclude from my end, our focus going ahead will continue on ramping up the B2C business on the back of investments in digitalization, marketing and expanding the home visit service locations along with the planned network expansion. On the acquisition front, our efforts will be focused towards the smooth and quick integration of Hitech's operation with Metropolis to drive the synergies. That's all from my side. I will now ask Rakesh to take you through the financials. Thank you.
Thank you, Vijender. Good morning to all on the call. Let me give you a snapshot of our financial performance. The Hitech numbers are consolidated with Metropolis with effect from 22nd of October to 2022. 21, the day the acquisition was completed. Revenue for Q4 financial year 22 was up by 5% YOY to rupees 305.9 crores. Revenue for financial year 22 was up by 23% YOY to rupees 1,228.3 crores. EBITDA before CSR and ESOP for quarter 4 financial year 22 dropped by 20% YOY to rupees 82.6 crores due to high revenue base including COVID testing in Q4 last year. EBITDA before CSR, ESOP and one-time acquisition cost for financial year 22 increased by 20% YOY to rupees 361.6 crore. EBITDA margin for the same period stood at 27% in Q4 financial year 22 as compared to 35.5% in Q4 financial year 21. EBITDA was impacted mainly on account of significantly lower COVID revenue and price capping by government that makes COVID testing margin significantly lower than non-COVID. Investment in digitization and marketing in a bid to improve customer experience and faster growth. Increase in employee costs on account of strengthening of leadership team and front-end staff. Investment in lab expansion, which means carrying month of fixed cost before lab launches. EBITDA margin for financial year 22 stood at 29.4% in financial year 22 as compared to 30.2% in financial year 21. Reported PAT for Q4 financial year 22 stood at rupees 40.1 crores. Reported PAT for financial year 22 stood at rupees 214.7 crores. Coming to our working capital ratios, our debtor days have significantly improved from 41 days in March 21 to 31 days in March 22. Overall, working capital days have increased from 4 days in March 21 to 14 days in March 22 on account of early payment to creditors. OFC to EBITDA stood at healthy 98% in financial year 22. Cash and cash equivalent stood at rupees 181 crore as on March 22. Total debt drawn for the acquisition of Hitech was rupees 300 crore, of which we have already repaid around 42 crore. We plan to repay the external debt of acquisition by financial year 24. For financial year 22, we paid a dividend of approximately rupees 40 crore, translating to a payout of 20% of that. In financial year 23, we expect margin to reach pre-COVID levels. We are deploying all efficiency levers like automation and digital enhancement, zero-based costing, process re-engineering and improvement, and better break-even of newly expanded network to maximize margin enhancement. That is all from our side. We now leave the floor open for Q&A. We request participants to refrain from discussing around recent news item. We will not be able to provide any comment on this call. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Praveen Sahai from Edelweiss Financial. Please go ahead.
Yeah, thank you for taking the question. So the first question is related to the non-COVID revenue excluding Hitech, which seems on a down on a YOY side around 3%. So can you give some more color on the volume or realization related to the non-COVID excluding Hitech?
So I think, as you know, the non-COVID is made up of the normal trade business. It's also made up of some government contracts and likes. As we had mentioned in Q3, the volumes of the government contracts were a little bit lumpy quarter to quarter. And that is the only reason why you're seeing it's sort of a negative trend on a YOY basis. But if you look at the core business, it is not a negative growth at all. In fact, from Q3 to Q4, we've actually seen a significant growth on a quarter-to-quarter basis on non-COVID.
Thank you for this. Second question is related to the Western geography. There also a significant dip on the quarter four is seen. Is it only because of a COVID or there is because of a competition, realization is down? Can you give some detail on that?
The geographical distribution has obviously changed with the acquisition of Hitech because obviously South has become now a slightly larger contribution to overall revenue. But except for that, we are not seeing any negative growth on the west side. It is continuing to grow, and in fact, we have started a lot of centers as well, which are all growing well and breaking even faster than we originally had experienced. So at this point of time, West continues to grow. It's only the COVID revenues and the COVID rub-off revenues, which obviously were highest in West, which probably will have some impact. But on the non-COVID side, things are moving as planned.
Okay. And last question I'll take and then come to the queue. So on the expansion plan, as you had mentioned about the 90 labs, out of which 16 already been commissioned, 74 are still in the next 2 years. So can you give us some, or even in the network, like around 1,219 networks are also going to be added in this 2 years. So can you give light on the geographical mix? As already you had said that 150 around is in the Bombay, but more color on that, like how the south or the west and the north you are planning for the geographical expansion in these lab and network expansion.
Vijender, do you want to take that?
Yeah, so basically what we've done is we've divided this whole network expansion plan based on core markets and non-core markets. And as you know that core markets are our major profit-making markets, so we've decided to put in more infrastructure in these markets. And there are a couple of other markets also like North India, East India and South India where we are also trying to kind of expand into newer cities by setting up franchisee network. So it's going to be a mix of network across the geography. However, majority of the expansion will be from core markets because there we have seen the returns are faster and the break-even is much faster than the previous data.
So the major expansion would be on the core market and on the asset-light model.
Yeah.
Okay, thank you. I'll come and queue. Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Anived Portfolio Managers. Please go ahead.
Yeah, thanks for taking my question. Meera, you did mention about, competitive intensity being on the rise. So, if you could give us some sense, is it just local players, coming back due to COVID wave, or is it, new funding by private equity players? And, in this context, is specialized tests the only way to beat competition at our end? And, if you could give some sense of what is, the contribution of specialized tests for us on an annual basis in terms of percentage of revenues?
So it's in our presentation. The specialized test is about 40%. This quarter, I think overall for the year, if I'm not mistaken, is about 42% of our revenue. And just in terms of talking about competition and who's entering, you're seeing a variety of people entering, and let's understand the logic why. So what happened with certain amount of digital health movement trend happening, where we saw in the last 2 years that a certain segment of society is now trying to get telehealth or teleconsultations, or certain societies getting e-pharmacy. So there are some pharma companies who are saying that they are worried about being disintermediated. So they are saying, can we build a B2C platform where we can combine our pharmacy, we can combine teleconsultation, and we can combine diagnostics and offer it as a combination platform to consumers. So that's one kind of an existing pharma company who feels that they have some relationship with either patients or doctors is trying to get in. So that's one. The second, you're seeing hospitals who are saying that, look, I'm doing pathology in my hospital, so why don't I extend it and do it outside the hospital? Now, the dynamics, obviously, for doing pathology inside when it's captive and doing it outside when you have to go and earn the revenue only on the back of pathology are two very different dynamics, right? But that's the second kind of competitor that we've seen come in. The third is the health tech players, the new digital health tech players who have come in and are trying to basically, offer a variety of services, which include e-pharmacy, telehealth, diagnostics, other things, all as a part of an aggregation to the consumer. So we are seeing, these 3-4, I would say, are the main varieties. We've actually not seen that much amount of private equity funding at this point of time. In fact, there are a lot of diagnostics firms which are actually available for acquisition at this point of time. So that's the nature of the competition.
Okay. And in this longer term approach to, grow the business faster and, gain market share. So where are these, smaller local players? Because, some of them had very good revenues due to COVID. So how does that, shift in the medium term happen where, larger players can grow faster and, some of these smaller players get disrupted? Because, they also seem to have done well due to COVID.
So I'll just give you a quick understanding of the industry and the different layers. So, I've often said this, to look at the industry as a pyramid. So at the top, you've got sort of the 4 national players which are operating and which are pan-India and which 3 of the 4 do sort of, good amount of specialized tests in a sort of a larger test menu. Sure. At the middle rung, you have about 30, 40 regional chains, right, all across the country, which are focused in one territory. They are in one state or maximum in 2 states, and in sort of in a local constituency. Now, the people who have done well during COVID are the national players as well as the regional players because they had the capability to do COVID testing and molecular biology testing in their local places. And consequently, the most of the ones which are on sale are also the regional players. Because they have benefited so much during COVID, that kind of growth they probably are not going to see for the next few years, right? The small players, which are the unorganized players on the bottom of the pyramid, are almost 150,000 such small labs. If you color, of these labs, most of them have revenue from sort of 2 lakhs a month to maybe 5, 7, 8 lakhs a month. So these are not very large labs. These are very small labs which actually have a captive patient or captive doctor base in about half kilometer around their location. So it's a very hyper-local business, and they basically are tied up with, let's say, 10 or 15 doctors in that region who sort of send patients walking into that center. Now, with the trends that are happening in the industry, where you're seeing digital health come in, you're seeing large distributions come in, this entire industry is going to get restructured. So, often investors have asked us what will be the catalyst to move more unorganized to organized, and I would say this is the catalyst. The market is changing, consumer behavior is changing, and I would expect the consolidation from unorganized to organized will be much faster at this point of time going forward than it has been in the last 10 to 15 years. I think the top players, sort of the national players, if they do the right strategy, will continue to grow and get stronger in the time to come. And I think it's the smallest players who are going to have a hard time struggling because neither are they able to give consumers the kind of technology-enabled engagement and services that customers want. Neither do they have the distribution. Neither do they have the specialized test menu that keeps them away, or they don't have the brand. So I think it's the smallest players that are going to get disintermediated in this process.
Understood. That's very helpful. And lastly, from my side, are we seeing any inflationary pressure? Because, most of the businesses seem to be witnessing a lot of inflationary pressure. Any input cost, any collection cost, anything which you think is inflationary in this current time, and will, price hike be on the anvil? Will, the same pricing continue for us and the industry? If you could share some thoughts.
Sure. So we did a marginal price hike at the beginning of this quarter, just for example, from an inflationary perspective. And it was again very, very marginal, only impacting very small number of geographies on the B2C side. So very incremental. But this was not done really because of inflationary pressures. We are seeing obviously the imports that the industry uses for testing, the chemicals and the kits are mostly imported, and therefore they are usually dollar and euro denominated. So there is obviously some pressure from vendors on prices because of the dollar rupee currency exchange. But we are sort of balancing that with our own efficiency initiatives to say how do we be more operationally efficient in the way that we manage our chemicals.
Okay. And this is across West India or specific geographies where we've taken some price increase on the B2C side?
It's been specific geographies all across the country, but like I said, very marginal, very incremental at this point of time.
Okay. Thank you so much. Thank you so much. All the best. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1 now. The next question is from the line of Pooja Bhatia from Morgan Stanley. Please go ahead.
Good morning, everyone, and thanks for taking my question. So in the core business, comparing to pre-COVID levels, patient volumes are up 16%, but realization is up only 3%. How do we see the growth in realization? I understand that the test mix will change with more of semi-specialized, specialized increasing, more wellness growing, I think more of home tests. But that's not going to happen overnight. It could take a few quarters or maybe a few years. So is it the right understanding that realization growth could be, say, in low single digits?
Yeah, I think the numbers I think you're quoting are overall, if I'm not mistaken, and that includes COVID. So COVID, as you know, the pricing, which started off as 4,500, came down finally to 300-400 rupees, per test across most geographies. And therefore, the revenue per patient from COVID tends to be much lower than our non-COVID revenue per patient. So in quarter 4, for example, where you have a wave and COVID volumes will surge, that's very natural to happen, that your test realization will not soar accordingly because it is diluted to the revenue per patient of non-COVID. Otherwise, if you keep aside any COVID business, we've actually only seen an increment on revenue per test and revenue per patient year on year. I think it would be premature to give any sort of guidance on this because the market is changing and we would like to wait and watch to see how things move. But we continue to obviously put our best efforts on keeping on improving the product mix, moving people up the value chain. And that's something that we've been successful at for the last many years and we would continue to try to do.
Just to add to that, so in case if we are expecting a low teen to mid-teen growth, most would be coming from volumes and realization would still be a little subdued. It wouldn't be contributing much. Is it the right understanding?
I think that would be assumption at this point. I think if you look at our past history, we have seen a very fair contribution from revenue per patient. And a fair contribution from volume. And I don't, see any reason why we would see a drastic change in that.
Understood. On the doctor recommendation part, it's not the price which is the major determinant of acute uptake. How do we manage this? What level of marketing promotion activities are you all expecting? And how do we add more doctors to our network?
So our energy is about increasing the coverage from our sales team and scientific team to meeting doctors. So we have about 400 odd scientific medical representatives. We also have a large number of sort of pathologists and doctors. And all of these are sort of our brand ambassadors who engage with doctors on an ongoing basis. The key way of engagement is actually scientific medical symposiums, continuing medical education programs, our teams visiting doctors. So the key drivers are, one, about making sure that the number of calls made by the teams are adequate in terms of visits to doctors. Number two is the constant training to make sure they impart the right education and awareness to doctors and the right positioning of Metropolis. And third is obviously then to say, how do we convert a doctor to prescribe tests that Metropolis offers, which are necessary for the patient. So these are all the drivers. It's not really about a push marketing because we have seen a push marketing is not the way to build a quality business. It will give you short-term growth but with large amount of discounts, and that may not necessarily be sustainable. So ours is a very scientific-driven, sales excellence-focused model.
Understood. On the network expansion, you mentioned in the opening remarks that you expect faster break-even in the new centers which are being added. So what will be the time frame for it? Would it be 12 months, 24 months?
You're talking about the collection centers?
Yeah.
So we are seeing in strong geographies, in focus cities. Earlier, we were looking at sort of centers, breaking even within sort of 9 to 12 months. And we're now seeing that timeline actually shorten to close to 6 months to 9 months. And the reason for this, I think, is a better selection of partner, stronger brand, more, where consumers want to come to our brand, better engagement, a bunch of reasons.
Understood. Very helpful. I'll get back in the queue.
Thank you. The next question is from the line of Anubhav Agarwal from Credit Suisse. Please go ahead.
Yeah, thank you. Good morning. Ameera, you mentioned that quarter one revenue will be down year-on-year because of the high base. Just a clarity over there. What is your expectation about non-COVID business? Do you expect that to grow year-on-year basis?
I don't have an answer right away, but I would say yes, overall, I think it's the COVID base that would cause a concern, not so much the non-COVID.
Because the reason I asked is in quarter four itself, the non-COVID revenues are still higher than quarter one non-COVID. So sequentially, you do expect June quarter non-COVID business to be higher than the March quarter non-COVID?
It's a little difficult to look at our business sequentially, which is why we always provide information year on year and quarter on quarter, because there is a seasonal impact that comes in. Health is not a consistent subject. It depends on the infections and the diseases that happen in that seasonality. Usually we have seen, if you look at the past, the data is available. If you look at the past 3-4 years, even pre-COVID, Q4 is usually a good quarter. Of course, in this quarter, there was COVID, so therefore the non-COVID was more subdued. Usually Q2 is another quarter which is considered one of the highest because the infections are at the most during the monsoon period all across the country, and therefore gives rise to fevers and other infections. Usually a Q1 is a decent quarter, and Q3 is usually the weakest quarter because of festivals. That's usually the pattern of how we've seen things play out in history.
Okay. So just to correct, you're saying that non-COVID business should grow, whether it's a mid-single-digit growth or high single-digit or double-digit growth, that's you're not sure about?
I'm saying year-on-year non-COVID will grow, yes.
Okay. And secondly, on the margin guidance, when you talk about pre-COVID, can you help us understand that pre-COVID numbers? In the sense, right now, if you look at the margin the company has done in the last 2 quarters, 3Q and 4Q, are you talking about that fiscal 23 EBITDA margin can be 200 to 300 basis points higher than that? Because pre-COVID you have done very different kind of margins. Can you help it quantify it? What range are you talking about on the margin side?
Yeah, so I will.
Yeah, go ahead, Rakesh.
Yeah, I will take this. So if you look at the pre-COVID level, we have done between 27 to 28% consistently for 2-3 years before the COVID came in. So we expect that is how we are guiding the market, that we expect that we will go to that level where we were in pre-COVID level, and obviously from there we can look at increasing things as we go along. So that's how it looks like. It should not take a very long horizon pre-COVID, but I think 2-3 years before the COVID period can be the ideal numbers to look at.
But Rakesh, this quarter also you have done 27% margin, right? So then you are not talking about expansion of margins from this level.
So basically 27% is the margin which is obviously looking at before ESR and ESOP and all. So there is a 1% there also. So if you otherwise look at it's 26 around 26.2. So we are looking at saying that how can this 26.2 can move upward to 27.5 to 28. That's how we are looking at from an expansion of margin point of view. But obviously we're just holding it back so that let's see how things goes in next 2-3 quarters, and then we'll be more firm on these things. But at least we expect that the numbers will be more or less in line with what we were doing at the pre-COVID level.
Okay, that's helpful. And last question is on this investment, and I'm talking about OPEX here, not the CAPEX. OPEX on digital, more advertisement spend, as well as incremental spend on this network expansion. Can you just roughly talk about how many crores kind of expense you're talking about incremental from here? Very rough number range you said.
See, we have already given a guidance that for a network expansion, we look at 0.6-0.7% of margin dilution, which will happen because one is that when we open a lab, the lab takes its own time to open up, and we have a cost which comes before that. So that's one. And obviously, when lab opens up, it takes its own time to reach to a level where we want to. So 0.6-0.7% of dilution coming from there, and obviously some 0.5-0.6% of dilution coming from the digital network marketing and other piece. So if you look at both of this, we will look at 1.2, 1.25. But obviously, this number will keep changing as we move ahead because some of the centers will become more matured as we move along, and that will start contributing to it. So I think it will be more in that line, but obviously maybe a bit changing here and there.
Okay. So 1% is more like 12 to 13 crores, the number we're talking about. So part of it we would have already spent in third and fourth quarter. That's why I was looking for more incremental kind of guidance from your side.
So I think the guidance is again very simple, that we want to maintain at least the pre-COVID level, which we have spoken about, and that is where we are. And obviously there are dilutions happening because of a lot of things happening, and there are a lot of efficiency projects and cost efficiency things going on in between. A lot of automations projects are going on. So hopefully we will nullify this both the sides and see if we can maintain the pre-COVID level. That's how it is.
Okay. Thank you very much.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Bharat Seth from Quest Investment Advisors. Please go ahead.
Hi, Ameera. Congratulations on a challenging time. Reporting good number. Ameera, when we are talking of the growth in different geography, so how do we really would like to play in those geography vis-a-vis margin where the break-even takes little more time? And second, in those geography where our brand name is not that really, visible to the medical fraternity. So how do we really plan to build that business?
So a good question. I think in markets where we have to remember two things. That, for example, markets where the consumer brand may not be very strong of Metropolis, but the fraternity, the healthcare industry and the fraternity knows Metropolis. So the issue is not about doctors not knowing Metropolis, it's more about consumers not knowing it strongly as a strong consumer brand. So really the differentiation is there. So even today, whether you take a Delhi or a Calcutta or Punjab or any of these markets where we are not in the top 2 or top 3 in the market, but more sort of number 3, 4, 5, If you look at it, sort of the fraternity, hospitals, labs, doctors recognize Metropolis and but the quality of it. Of course, this will never be 100%, but it will be a large number of doctors. What we usually do when we go into a new market like this is we start with the B2B business, where we actually go and educate doctors, labs and hospitals about our brand. So in a market like Delhi, we've been doing that now for many, many years. And we start our reports circulating in that market through B2B channels. As the brand starts circulating more and more, the brand becomes more familiar. And at the right time, when you feel like you're ready to make a large B2C investment, it then makes sense to start with B2C. Having said that, we all know building a consumer brand takes a long time, especially in healthcare, because it's not something you can do simply through advertisements and other ways like FMCG, because it's not a business which is built on the back of advertising and marketing. It's a business that's definitely not for illness. It's a business which is built through engagement and trust and experience. So therefore, we would start B2C like we have in many of these cities, but probably not in a huge way overnight, but more in a creeping style where you keep expanding your centers and keep trying to work in that hyper-local market to get B2C patients.
And second question on when we are talking of specialty, so have we really added any more capability on the specialty side in last 2 years, and or how do we really plan to expand that portfolio?
We've absolutely added a lot of capability. So we have now got all kinds of, we obviously already did genetics. We have all kinds of genomics. So we have added a lot of capability on multiple areas and constantly to make sure that we are pioneering in the test menu. And we also do R&D in-house to sort of see how we can make more tests more affordable. Certain tests which may be quite expensive, are there new technologies or techniques we can use to make them more affordable or more relevant to the Indian population. For example, when we get most of these technologies, they come with reference ranges which are actually relevant for an American or European population because the R&D is done there. How to make this relevant for Indian population, which fits our genetic parameters. This is the kind of work we do behind the scenes that helps us actually go to doctors and say, look, you should use our test because we are the only ones who have an Indian reference range, for example. So there are many such things that sort of happen, but absolutely we keep expanding the menu.
And last question from my side, I mean, when we are talking of this disruption, so all these like several aggregator which has recently is seeing a good run like in Zomato and small restaurant, and so we are also seeing in this medical diagnostic industry some of the aggregator is appearing, and so how do we really plan to work? I mean, whether compete with them or complementary to them, or and vis-a-vis this one and a half lakh small lab which are already present. So how do you really plan to grow with this kind of a scenario?
See, we have to be very clear about who we are and what, where are the areas we want to compete. So we are very clear that we are not interested in competing with the aggregators on the low-priced wellness business because we feel this is just a quest for acquiring consumers and in a very non-profitable, non-sustainable way on the wellness side. And that is a business that we feel does not make sense for us at this point of time to compete with them to acquire consumers in that way. So we are therefore not competing with them on the low price wellness. What we are doing is we are saying that how do we continue to participate in the wellness business, but using our brand, our technology, our quality, our services, and therefore continue to compete more on the premium wellness segment, which is what we are doing. As far as the aggregators, we are very open to partnership. We are open to working with all the aggregators in the industry. In fact, we already are. But I think what you will see in the next few months is many of the aggregators which have been doing a lot of very high-profile marketing and spending a lot of money. We have to recognize that the change of the economic environment, many of them are also having a very hard time in securing funding. And I think we'll see some sort of a consolidation in the aggregator space in the coming 6 to 9 months as well. So I think we have to stay to our journey, what's good for us. And if there are opportunities to work with aggregators, we are absolutely open to in a way that is economically makes sense.
Okay. So how much is our wellness portfolio, size of the wellness portfolio that contributes to overall top line?
10%. This quarter, it's 10%.
And annualize if we...
About 8%, if I'm not mistaken, Rakesh, 8%?
Yeah, so we were pre-COVID level, we were at 6-7%. COVID time it has come down, and now it is increasing, gradually. So we have seen that this contribution going from 7% in quarter 1 to 10% in quarter 4.
Okay. Thanks and all the best.
Amira, I want to add one more point to this question on aggregator.
I'll appreciate that.
See, what we believe that, with aggregators, I think the overall consumption in diagnostics will go up. And within this wellness, we hope that 20% would be illness also. And this illness will become TG for a company like Metropolis, because our focus is going to be also on Doctor Connect. And for illness, largely the patients, they would go to doctor for their, treatment, and hence this becomes our TG. So overall, this will help us in creating more, business opportunities.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Rahul Agarwal from InCred Equities. Please go ahead.
Yeah, hi, thank you. Just 2 questions from my side. So firstly, on non-COVID, Amira, a lot of discussion happening around the growth part. Obviously, despite of COVID in Jan 22, we've grown both YOY and QOQ. But a simple question, when do we see non-COVID revenue, excluding COVID allied, obviously, growing at 15%? We are all used to looking at that number, this industry growing at that number and large organized players getting a lot of market share. The entire concern around this competition, I think, is because that number is not growing. They're still hovering around 5 to 10% in terms of growth. Could you give us some sense, as in, from wherein you see, and obviously there is an assumption here that COVID not recur, that when do you see this 15% non-COVID revenue straight B2C revenue growing for Metropolis?
So Rahul, I don't have a crystal ball, so it's very difficult to give an exact timeline. But what I can tell you is that we have to understand that when COVID happens, the reason non-COVID comes down is because people are sick with COVID, and therefore that's the disease that takes priority. And therefore other things get ignored or they don't happen because you're at home recovering from COVID. In every quarter, even if you look at Jan, Feb, March, you'll see Jan had the lowest sort of non-COVID. Feb also had the lowest non-COVID, and then March sort of picked up in a much better way and had a much better growth. But these things tend to be very seasonal based on the kind of infections that you're seeing. This is not something that can be, like we said, a push marketing. If somebody is sick, then they need to come. And generally what we are seeing is that as COVID has taken over sort of all the health issues for the past few months and past couple of years, other things have come a little bit more on the side. I don't have an estimate in place, but I can say that my mind tells me that if COVID, we don't see another wave, my sense is that by Q2, we should see more of a normalcy in terms of a positive growth number going forward. And I'm fully hoping that we don't see any more disruptions like any other severe infections or severe, COVID variants that come along the way.
Right. So in normal, removing COVID out, we should get back to that number, right? I mean, that's the entire effort is focused on that. Is that correct?
Well, I mean, of course, the effort is completely focused on non-COVID. I don't think there's any effort going into at this point on COVID. Of course, if people fall sick, we have to take care of them. But the entire effort is going into non-COVID, building geographical expansion, building business, going to doctors, doing better coverage. And that's all the efforts are going in that direction.
Got it. And our smaller question was on routine testing. So my sense is, generally routine tests have higher gross margin versus specialized. And on EBITDA level, they're pretty much similar. For a typical test like lipid profile or thyroid, what would be a reagent cost for Metropolis at volumes you do? Because that's the number I'm looking at on an absolute basis, which is the minimum break even at gross level, right? I mean, could you help me with just one number here?
I mean, a gross margin percentage is what you mean?
Yeah, I mean the reagent cost for a lipid profile or a thyroid test at current volume for Metropolis per test, how much would it be? Would it be like $80, $100, $60?
Difficult to give that number because that contact information, costing information is obviously confidential to the organization. But what I can share with you is that there is the gross margin on routine tests. It's first thing to remember about testing and pathology is that the material cost is not the biggest cost on the P&L. The biggest cost on the P&L is the servicing cost. So, while somebody may say, okay, if the MRP is 100 rupees, and if your cost of a test is 20, then why can't you sell it at 30 rupees? Because out of that 20 to 80, almost 50 rupees is the servicing cost. You have a cost of a flebo, you have a cost of property, you have cost of consumables to do the collection, except the cost of testing people, etc., etc. So the material cost is something which is important, but it is not the only important factor in the entire costing. Traditionally, we see that routine testing has the highest gross margin, but routine testing can again come in multiple ways. Routine testing can come either through a strong brand like we have, or B2C, where you are able to get a fair market price. But if a routine testing is coming through this kind of discounted aggregation that people are doing, then the servicing cost will actually completely destroy any profitability on that test. And there would have to be losses incurred for them to be able to make sense of it. So I think what we are continuing to see in some of the aggregators is, like I said, a consumer acquisition spree at any cost. And the thought is to say that, okay, we'll fund it till it makes sense. But the real question in healthcare is whether consumers are going to react to that, looking at only price. And like we already discussed, that may happen on wellness and chronic, but not so much on.
Perfect, Amira. That's the point I was trying to drive to, that, just saying that 100 rupee a test is profitable on TV, it's basically meaning that maybe you're profitable on gross margin, but it's impossible, after you account for servicing cost. But anyway, we'll take that discussion forward. Thanks so much for answering my question.
Thank you. The next question is from the line of Tarang Agrawal from Old Bridge Capital. Please go ahead.
Hi, good morning. Couple of questions. One is, lack of a cross-selling platform an impediment for you? For instance, you have a hospital, pharmacy, diagnostics, or now with the newer players, you have a host of other things on their platform where they're trying to cross-sell, which gives them some sort of economy and a good customer stickiness. So is that, you feel, an impediment in so far as your business is concerned, and would you be sort of open to some sort of a partnership to have that in place? That's one. Second, pardon my ignorance, but if you could just give me some sense on how you define your specialized and wellness and other category of tests, and some quantitative sense in terms of the breadth and depth of your portfolio there versus incumbents in the market.
I'll start with the second. So we have a large test menu of about 4,000 varieties of tests. If I compare to a couple of the other national players which also do a larger test menu, there would be a difference. We would be higher by maybe 20% over some of the others. Obviously, the fourth player, which does mostly wellness on B2B, will do a very limited number of tests, about 200 varieties of tests. So that's really not a comparison point in terms of the business model. The 150,000 labs which are on the street, which are doing that 2 lakhs to 5 lakhs, 7 lakhs business per month, will only do 50 varieties of tests. The slightly larger labs, which do maybe 10, 20 lakhs a month, will do maybe 100, 150 varieties of tests. Even top hospitals, where you guys go for tertiary care, would do 3 to 400 varieties of tests. A regional chain would do maybe 500 varieties of tests. So I hope that gives you a sense on the level of complicated and very comprehensive tests that we do when we have a test menu of 4,000, which is equivalent to the best global players of offering everything under a platform. The reason I had mentioned in the speech was that this is difficult to replicate is because these volumes of these sort of tail end tests of the, what you call as the bottom 3,000, 3,500 tests tend to be very, very small in number, and you need to accumulate these volumes through a national distribution from all across the country to bring them to one place and commercially make it viable to get economies of scale to actually run those tests. Otherwise, for any player who doesn't have a national distribution, and not only national distribution, but the ability to generate those tests, because these are very specialized medical tests, and you have to be able to go to the doctor and convince them on your expertise on each one of those tests. So, for example, if you're showing a neurological test, the question is, do you have a pathologist who's very, very high knowledge on neurology? Do you have your interpretations which are high, full knowledge on neurology? So there are a lot of things that go behind the scene. It's not just going and, picking up a test. So that, I hope that answers your question on the test menu and the scope of it.
Yes. I'm sorry to interrupt. Just to follow up on that. So out of your 141 odd labs, my sense is only a specific set of labs would be capable of administering these 3,500 tests, and then servicing them over a couple of days or so on and so forth. Would that be the right way to look at it?
That's right. It works in a hub and spoke model. What's unique about Metropolis is that we have almost 10 regional reference labs in India, which means that while we have 170 odd stat labs which do about 150 varieties of tests, we have 10 regional reference labs which do about 400 to 500 varieties of tests, which is the highest amongst all our peers. This gives us an ability to do more tests locally, which is very valuable in the quality of the business that you pick up, because you're able to give a faster turnaround time. And then we have the global reference lab, which is based out of Bombay, which does all the 4,000 varieties of tests. This is a very normal structure and practice globally, that you consolidate the volume of specialized tests, because otherwise it economically doesn't make sense to do that.
Got it.
Coming to your first question on the platform play, I want to reverse the question and ask the question, why do people even think a platform play is the way to go? I think this idea has come from China, where we have seen platform plays do well. But if you look at the ecosystem of the Chinese market, before consumer healthcare came in, everything was state-run. Everything was run by the government or in very large hospitals. And therefore, a consumer play where you could book everything together on one platform became a very attractive thing for consumers. That is not the problem in India. In India today, consumers already have access to a completely retail healthcare ecosystem. They are not forced to go to the government or go to any institution for anything. They already have all options, at their table. So the reason why your e-commerce platforms do well is because you will end up ordering something from this e-commerce platform every day. Sometimes you'll order, something small, the next day something small, and it makes it very convenient. But if you think about your own lives, how often do you engage with healthcare systems? You may order drugs once a month. You may go for a test once a year. You may need to see a doctor once or twice or 3 times a year. This app is not going to be something that you're going to get onto every day where you're ordering something. And therefore, the habit and the use of the app and the platform is far less frequent than what you would compare to an e-commerce player. So I think the debate and the discussion whether a platform play is truly going to succeed is a big question mark at this point of time for the Indian healthcare ecosystem. Then it comes the question of, do we think we are missing out because of an upsell or a cross-sell? But is anybody able to do an upsell or a cross-sell? Is it proven? It's not. At this point of time, there are a lot of theories around, we will cross-sell from e-pharmacy to diagnostics, or we will upsell from here to there. But is it happening? I think we should check. I don't think so.
Wonderful. Thanks.
Thank you. The next question is from the line of Shanti Patel from Shanti Patel Investment Advisors. Please go ahead.
Is increasing. The latest entrance is UK. Even Adani is coming, and Tata 1mg also is starting. So looking to all these things, do you think that the market share will go down as far as Metropolis is concerned?
I mean, I don't know how to answer this question because
if we believe
that there are only 5 groups that can succeed in every business, in every industry in India, then that will basically, we will say that entrepreneurship is dead in our country, and consumers will only go to these 5 groups for everything. We have to remember that that is not the case today. There are many groups flourishing and many people in even a particular segment of society. There are many businesses flourishing. I think it would be fear of the unknown to say that, oh, now if this group or that group comes in, everybody else is going to have a hard time growing. I think that would be a stretch in my opinion. I think we have succeeded, for our own part we can speak, we have succeeded very well in diagnostics and become a leader in the space based on the DNA, the hard work, the distribution, the specialized tests, and more importantly, the expertise that we have built up in healthcare. This is not so easy to replicate. I want you to just think through your own examples and say that tomorrow if any one of these groups just came in and said, oh, now we are offering, all services, are you going to stop going to the doctors that you trust because somebody else is offering it? I don't think it works like that when you're sick. When you're sick, you want to go to people you trust. You want to go to where you feel you've got reassurance that you're going to get better, that you're going to get the right test. When you have cancer, you're worried about treating the cancer. You're not worried about whether you go to group A or group B. You want to go to the doctor, the lab, the treatment, where you're going to get the best treatment possible and get well soon. That is our belief in the way we built the business and what we see of the market that we understand.
No, I entirely agree. You are very intelligent, very enthusiastic, very firm on your beliefs, etc. But, in our area only 2 or 3 diagnostic centers were there. Now UP has come, then some RG, I've forgotten the name, some 3-4 new entrants have come, and they are very strong. So, I mean, naturally one will feel that the market share will, it has to go down, no? Because others will otherwise they don't have any business. From that angle I was asking. I don't have any doubt about your competency, your intelligence. Yeah.
The market is only 15% organized segment and 85% unorganized. Okay. Why is there the assumption that any new entrant is going to come and eat up the market share of the 15% players? Maybe it is possible that the new entrants will come and take some of the market share of the unorganized.
I agree, unorganized and little bit organized also, because, I mean, I don't know, you are in the field, so you are in a better position to express your opinion. And in stock market also, see, the moment this, what you call it, Tata 1MG announced, the market price of share went down. It may be a psychological, I don't say if it is in reality with a fact, but that is the psychology with which the people think that yes, market share may go down, may not necessarily, but probability.
Well, sir, I can only talk about our industry, and I'm sure in the stock market, if everybody started following the psychology of anybody who advertises, stock price of everybody else will go down, then nobody in the market will make money. So all of you are obviously very, very intelligent investors, and I think you can probably see beyond the basics of the market.
In your case, you see, it's like depending upon the experience, depending upon the intelligence, depending upon the past experience, one has to rely on you. I don't deny that. But I was thinking, let me have an explanation. Fine, I will accept your explanation and let us see next year what is the situation.
Sure. Thank you.
Thank you. Thank you very much.
Thank you. The next question is from the line of Namit Mehta from KC Capital. Please go ahead.
Hi, thanks for taking my question. Just a couple from my side. One, I just wanted to understand whether competitive entry changes the dynamics in terms of franchisees, whether in terms of acquisition or management or churn. Are we seeing some of these franchisees going to the more aggressive peers, maybe offering higher margins and so on, and do we need to match those? How do those dynamics play out?
So franchisees are unlikely to go to new entrants because franchisees only survive based on the business that we generate for them. And therefore the brand is very important. Because you have to remember that the sales generation is done by the organization and only the service fulfillment is done by the franchise. Therefore, the franchise is quite dependent on the brand to generate. So if they go to a new brand which offers them higher commissions but doesn't give them even half the business, then it's a loss-making proposition for that franchise. I think if there is any poaching that happens or any thing on franchisees, it tends to happen, and that's also very, very marginally. We don't see this as a big trend between the incumbents who already have strong brands and not really with new players. As far as acquisitions, like I mentioned, there are many deals available on the table. So far, at least, the few competitors that have come in are hoping to build organic business by building distribution. I'm not seeing them in the market at this time for acquisition.
Understood. And I found what you said on the specialized test business in terms of economies of scale and volume very interesting. Just wanted to probe a little further and understand how competitive the specialized test business is. So in a Mumbai or a Chennai, what kind of market share would you have in this particular segment? And will some of the new entrants even try to compete, in those segments, given they don't have the volumes? Do you see people just sort of splurging money to be able to offer those tests, or is it more, that people like you focused on quality and with the experience and with the volumes are the ones dominating those markets?
The market has so first question, the answer is yes, the larger players do dominate this market. It's very difficult to give you a share of market because that data is not available in the public domain, in terms of any third-party data. But considering, 42% of our revenue comes from specialized tests, we definitely have the highest share of specialized tests in the industry. And of course, that would be fairly proportionate to the stronger market that we are in. On your question about new players being specialized, the market has all kinds of players, right? We have seen in the past, not even in this round of competition, but in the earlier round of competition between 2012 and 16, we saw one player come in and on a very specialized technology decide to try and just build large volumes by discounting the price more than 60 to 70% on a very, very specialized genetic test, and said that, look, I'll offer this at very, very low price at me build volume. And what landed up happening in the 7-8 years that they've been, or 10 years they've been doing it, they did manage to build some volumes initially, but it has always been a loss-making business for them, and it has not really ever become profitable or contributed to their success. They were not able to diversify from that genetic test to other tests to compete with us on a pan-India basis. They were not able to get the doctor's trust and credibility even for that genetic test, because in healthcare there is a mindset that the more you discount, the question comes up, look, are they even doing the test? Are they doing a good job? Do I want to go to some place which is just discounting? How are they affording it, right? And am I getting a poor quality report because it is so heavily discounted? So actually the lower pricing and the discounting causes a concern amongst patients in illness and doctors around the credibility of the test report. So we have not seen it actually, the strategy of price disruption, we have not seen it be successful for the many, many, many players which have come into the industry and tried this. And we have to remember that the 150,000 labs that exist are anyway at a significant discount to all the national and the regional players. So if pricing was the main thing, then actually the unorganized market would flourish far more than the organized market. So I think there will be players who will try, I would say, on the specialized side. Not all 4,000, but they'll try with 200, 300, 400 tests to try and make a mark. And if they try to do it in a rush with discounting, I think they will struggle. If they try to do it in the way that we did it, scientifically with expertise, they may have a chance of success, but then that will take time.
Understood. Thanks. And last question from my side. So do you think broad-based brands, which generally mean trust for the Indian consumer, translate well in the healthcare industry? So for example, for you or for Dr. Lal, you had to build up your brand from scratch and develop that over a long period of time to the state where you are today. But somebody like a Tata coming in today with that sort of day one reputation and trust, which is broad based across sectors, Does that translate well in this industry, or does that still require a very specialized brand focused on medical fraternity to succeed in this business?
Well, I don't want to comment on any specific player, but I want to give you an example. Even the top 2 hospital chains of the country, they try to take their brand and set up diagnostics on their brand, and they have far more trust in healthcare than any of the groups that you're mentioning. Were not able to be successful in diagnostics because they had trust from the doctors on treatment. But having trust on treatment for heart or gastro or neuro is not the same as having the doctor's trust on diagnostics. Healthcare is an area of subspecialties. To give you an example, if somebody in your family has got cancer and somebody is suspected of having lung cancer, let me tell you, you will not even go to a general histopathologist. Your doctor will say, go to this specific histopathologist who has got the maximum expertise in lung cancer. That is how subspecialty healthcare is, and especially illness. The expertise and the knowledge is what counts the most. And therefore, the translation of trust, general trust from FMCG brands to specific acute illness diagnostics is not so easy.
Perfect. Thanks so much.
Thank you. Ladies and gentlemen, due to time constraints, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you for you guys to organize the call, and thank you to all for attending and patiently hearing us for the last hour, 23 minutes. We hope we've been able to address a lot of the questions. I just want to leave you with 3 messages. That we have worked very, very hard over the last 40 years to build trust, credibility, experience, and knowledge and expertise in this industry. And there's a reason why we are leaders in the industry today. This has not happened by chance or by fluke. There have been many competitors that have come in, tried to do price disruption and other ways. And we have to just recognize that there will be some parts of the industry which will, like we said, the wellness segment, which may be more prone for disruption. But the parts of the business which are built on strong fundamentals are in the illness space, which is where we operate. We would like to continue our journey of building out our expansion, geographical expansion, product expansioning, technology changes, and really move towards a company that is not only strong in science, expertise, and knowledge, but also provides all the conveniences from a technology and a digital perspective to our consumers, and makes working with Metropolis and engaging with Metropolis a completely seamless experience. This is the journey that we are on, and we believe that we are very well placed to continue to compete and to do well for us and our shareholders. Thank you, everybody.
Thank you. On behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.